afternoon, everyone, and welcome to the SAVCA session on the VC survey highlights for 2021. It feels surreal to be having a conversation like this, given what's happening in our country at the moment and some of the devastation in parts of the country. But our thoughts go out to those that have been affected and that are affected. And it might be a good time to have this type of conversation, because if we want to build back better and if we want to leave no one behind, these are the kinds of conversations we need to have, where we reflect back on what was, but also what can be. So thank you for joining us this afternoon. Some housekeeping: if you have any questions that you would like to ask our panel, please use the QA function. Also, the chat function, if you have any comments you'd like to make or share your own experiences. We'll also use the chat function later for a competition that we're running. And we ask you to be on the lookout. We are going to share a few slides. Hidden in the slides is a little hint. Be on the lookout for this hint. Later at the end, when we close off, I'm going to ask you about the hint that you saw. And then there will be a prize for the first person in the chat that gives me the correct answer. In terms of the session today, the SAVCA runs an annual venture capital or VC study with Venture Solutions, and the study really looks at what the activity of the VC industry was the prior year. So in other words, how many investments were made into which industries, which regions received most of the investment, etc. So today's session is a glimpse of the highlights of that report. The full report is coming out next month, but as a build-up or a lead-up to the full report, we wanted to give you a quick view on the highlights in terms of how the VC industry has been impacted. And together with some of the findings, we've got a very astute panel here today to have a discussion about how the VC industry has been impacted. Before I hand over to our MC, a quick poll question. I just wanted to see your views on what you think. So if we can get the poll question up quickly, Maria. So the poll question is, in your view, do you think deal volumes in 2020 have increased, decreased, or remained the same? And Mosidi and her panel will give you the answer soon, but I'd just like to see what our audience thinks. Okay, we're getting some mixed reviews and you'll be able to see it soon. Some votes still coming in. And as you can see, 47% say it has increased, 40% decreased, and 14% remained the same. We will share those results shortly. But in terms of our session today, I'm very happy and proud to welcome Modise as our moderator for the session. She's the Managing Director of Pivot Ventures, which owns MOOP, which is an advisory firm specializing in sustainability strategies, project management, and creative communication services. Mosidi has moderated conversations on several platforms, including the World Economic Forum and TEDx, so it's great that she can be here with us today. She has over 12 years experience in investment management, hospitality, and management consulting, and is also a fellow GIBS alumni, but her specialization in her MBA was entrepreneurship. Mosidi, welcome. Thank you so much for being here, and I'm going to hand over to you and your panel.
Thank you so much, Tanya, for that warm welcome, and a very warm welcome to everybody joining us this afternoon. The aim of today, as Tanya has said, is to foster a meaningful discussion around this year's 2021 industry survey highlights. We do encourage you to foster some conversations as well as some questions, and feel free to post them in the Q&A session in your function in your Zoom platform. We are joined today by an esteemed panel of actors in the venture capital ecosystem. First up, we have Vuyiswa Nzimande, Investment Principal at Edge Growth Ventures. We also have the Vice-Chairperson of SiMODiSA, Matsi. Stephan Lamprecht from the Professional Strategy and Workshop Facilitator at Venture Solution is also joining us. And lastly, we also have Mr. Ketso Gordhan, CEO of the SA SME Fund. Welcome, everyone. So looking at this first slide that we're going to be pulling up, there are some interesting insights from the highlights of the report I'll just wait for it. Looking at the first one being that early stage investments saw a considerable amount of growth in 2020, amounting to about 1.3.9 billion rands plowed into the sector. So secondly, there was about close to 44% of funds being raised by managers came from corporates. And at the top of the sectors by numbers that received the most funding was software development, together with fintech, also still hot on its heels. My first question is to you, Ketso. What are some of the factors do you think are driving these trends in your view?
Yeah, I mean, I think, thank you for the question. I think the corporate involvement is quite an interesting thing. And I think it's driven mainly by the fact that large companies want to be innovative, are constrained by their own large bureaucratic structures from doing it directly. And so they are doing it via intermediaries. And we've seen Standard Bank and Netcare and MMI and a whole bunch of other corporates either put money directly into a VC fund, focusing on their own particular needs, or putting money into a variety of deals. I think the second reason is that VC is definitely getting traction as people begin to understand the kind of positive exit stories that have emerged in South Africa over the last few years. We've had one in the last month coming out of the Grindstone Accelerator, sort of very early stage business that got a $10 million exit. When these stories get out, I think it creates a huge amount of excitement and a better understanding of the possibilities, for VC. And I think lastly, there's been a push on the supply side, which has been driven mainly by having the 12J sort of intervention, tax intervention, but also from ourselves, the SASME fund, which is probably one of the larger institutional investors into VC. We've given birth to 5 first-time fund managers just in the last year or two.
Excellent. And just building on that, to you, Stephan, we see that 44% of the funds being raised by managers is coming from corporates. Are the corporates establishing their own VC functions or funds, or are they allocating this funds to existing fund managers?
Yeah, thanks. Thanks for the opportunity also to participate. I think the main thing is it's in terms of the fund classification. And when we talk about corporate investors, we refer mostly to fund managers that are investing off their own balance sheets. Many of these are corporate entities, either listed or large unlisted enterprises, holdings companies, financial services, large conglomerates that's got a variety of portfolio companies that they manage that are investing directly in the early stage space. Even if you think about some of the fund managers like business partners and other fund managers that sit within the Remgro group would be classified as corporate investors. So they don't necessarily invest with a ring-fenced VC fund. And as I mentioned, they invest mostly off their own balance sheets, doing so as and when required. And I think the main opportunity here is very much around, if you look at the sectors as well as mentioned, and the whole thing around COVID driving towards financial services and services in general. A lot of corporates are looking at small and medium-sized enterprises and startups to create and drive these opportunities because they sit at the cutting edge in terms of the technology and the innovation around it. So very much, and I think that's going to grow. It's not just a South African phenomenon, and it's very positive for us because I mean historically we don't have the kind of large insurance and pension fund contributions that you would like to see going into this asset class. So from that point of view, the corporate sector very much, I mean, the money is welcome and it's been allocated, and as Ketso has indicated, the successes are forthcoming. So it's starting to build momentum that it's very much going to drive the sector for a while to come.
Thanks for those inputs, Stephan. Vuyiswa, coming over to you, from which sectors are you seeing deals come from? And how has the process of doing due diligences been adjusted, given what's happened in the past year with a pandemic or exogenous shocks that come as a result of a pandemic such as COVID-19?
Thanks, Mosidi. I think fintech and software will probably be front runner for a while, given that the pre-proof of concept early stage businesses tend to focus on fintech, also because barriers to entry tend to be slightly lower than other businesses. But past approval, we've actually seen a lot more industrials, consumers, as well as B2B businesses across the sectors. So business products and services is the biggest one when it comes to actually getting past approval. I think the risk appetite still with a lot of the mandates doesn't allow for pre-revenue, which a lot of the fintechs and software companies are currently. In terms of due diligence, I can't say that there's been a big change, because in the VC space, it's very high risk, and our due diligences are very deep and detailed. But there's two main areas now that have become more important than the rest, which is the quality of the management team, their ability to be resilient, COVID or otherwise, and their track record that they've had in the past, even if it's not in the same business, just with general knowledge in the market. And then secondly, we've really had to do a deep dive into unit economics, price times number sold, having to really put your trust behind the numbers when you're forecasting, together with the management team, has become more important than normal.
Thanks for those insights. And moving over to you, Matsi, just over 53% of all active deals are into seed or startup businesses. So in your view, in South Africa, where are the funding gaps and in an entrepreneur's journey? And what can the community do to work collectively to fill those gaps?
I like the word that you use, Mosidi, community, because it takes a community to bring up a small venture, right? It's not just a small venture by itself. It doesn't exist in isolation. There is a market aspect, there is the access to funding aspects, and then also understanding at what stages do we get the success factors that we've been able to identify, and what does that success look like? What are the demographics? Where are these deals coming from? Where are they nurtured? That's where the whole community ecosystem comes in place. And I think the biggest gap from my experience is, before we tend to like to go to businesses that are post-revenue, but how do they get to being post-revenue to a point where now the likelihood of investors would take them seriously? Then it also talks to our ability to incubate and to accelerate such ideas. Where are these accelerators and incubators? Grindstone, Endeavor, these are some of the great accelerators in our country. But how do our network of incubators and accelerators become more inclusive? I think, the government obviously has a network of accelerators. CEDA used to have, but it's without its challenges. So how do we fix the issues that are existing in areas where we could be getting a lot of these great ideas to be nurtured to a point where they become post-revenue, and then it's easier for the investors, the VC community, to then engage with them. So I like the knife capital model, and there should be more of it. And I'm using it because it's the one model that I'm very familiar. Even Edge Growth and Vumela, those are great models, because then it's how do you create an accelerator, which will be a feeder into, these are potentially the businesses that we will invest in. It's not we just a fund. It's like, well, we have Grindstone, which is in essence an accelerator of great ideas. And once you've gotten to a point where now you can be post-revenue because we've been nurturing and accelerating you and incubating you, then we'll invest in you. So we need a critical mass of that. And I think, the government, given that they have the CEDA network of accelerators and incubators, they need to partner more with successful accelerators and incubators that have worked, that have been able to create a whole value chain of, we bring you into this whole environment, we nurture you, and then we invest in you. So how do we have more of those partnerships so that accelerators in township environments could also then collaborate with venture capitalists. And then it's an entire value chain of from an idea to when you now build in your business. So there's more collaborations that can be done so that we have the desired impact, because as much as we complain about it's not inclusive, it's what is stopping that inclusivity? What already is existing and how can we make that work, and how then do we collaborate more to make sure that with the public and the private sector, we work better to have a desired output?
Yeah, those are excellent inputs, I think, from everyone, just to open up the context. And as a one-year-old entrepreneur, I think one of the things when you talk about acceleration is about creating visibility for them. So when you talk about pre-revenue and post-revenue, what do you mean by that? It would be great to get examples of businesses that went through an acceleration process from start to end, so that, but then creating a platform for visibility for that, I think, is a key component. And like you said, there's enough key players or role players within the community, but it's just about creating visibility and going out there to the startups and working in a more collaborative approach to foster these growths of these businesses. Before we go on to our second kind of section that focuses more on the fund management composition of the reports, we're going to pull up another poll, and then I'm just going to take you through it and give you an opportunity to answer the questions. So the question of the poll is, what percentage of fund managers are reported to have female equity in their funds? Is it 3%, 25%, or 51%? I'm going to give you a few seconds to answer, and then we will just have a look at the results. Okay, have we got them in? All right, so most people answered, 48% of the people answered 3%, and 25% came second, and 9% was the third one. So in one of my questions, I will give you the actual answer, but the actual correct answer was 51%. So moving over to you, Ketso. So female representation in fund managers does seem to be improving at 51%. And of the fund managers reporting to have female equity. However, the VC managers operate small investment teams. There's a slide showing just generally how small these management teams tend to be. And fund managers in the market, what are your views, in your view, from a teams as an investor, in terms of this diversity in female representation versus the actual size of the general fund management team?
Firstly, thanks, Mosidi. Firstly, it was really disappointing to see the result to the poll. I mean, 9% got the right answer. You know, things are improving, and we need to recognize that things are improving, even though they are slow. They are moving in the right direction. What I've noticed in my short time in this industry is that there's different types of diversity that's required. 3 years ago, you know, VC looked like a Cape Town-based thing. Today, I think that, you know, the geographic spread across the major cities, certainly Durban, Johannesburg, and Cape Town, is well represented, and we've got to obviously get to some of the smaller centers around the country. The second clearly is gender, and while it is, you know, improving that there are a number of women in VC funds, we are not seeing enough women-controlled VC funds. The SASME fund has helped launch the first African women-only managed fund in South Africa, and we hope to see many more of these coming in the near future. The third form of diversity, which I think is as important as geographic and gender, is the verticals. You know, we can't have everybody doing fintech and everybody doing, you know, software. And so we've put a lot of time and effort into getting into hard innovation. So we've put money into Savant, which is an engineering fund. We've put money into the University Technology Fund, which is trying to commercialize IP coming out of universities, a biotech fund. So I would love to see more verticals covering, you know, all of the different economic sectors, and not just the few that people consider easy and sexy. And lastly, I think we are going to see a split between more experienced funds with a track record and more first-time funds. So clearly, based on the work in the survey, we can see that a very large grouping of funds have between sort of 12 months and 3 years of experience. And I think over time, we'd like to see, you know, a better spread in terms of the sort of different years of experience, so that investors, particularly institutional investors, are going to have more confidence in backing people with experience and a track record.
Thank you for that. Thank you very much. And Vuyiswa, from the results, we can see that 3 of the top 5 large and established fund managers made no new investments in 2020 due to COVID-19, and opting to rather set aside the capital for assistance into existing portfolios. So at a fund management level, how have you been impacted?
The first 3 months left a lot of dead bodies on our portfolio. There were a lot of businesses that completely shut down, especially level 5 and level 4, where most of the sectors were not operational. Some of the businesses chose to still pay salaries, which was honorable, but then obviously the turnaround time in terms of recovery after that took a lot longer. So there were some funds that were set aside to try and assist where we could, together with, you know, partnering with banks to help with application processes, to take advantage of the arrangement that had been in place at the time. However, even with all of that, we still had to do some restructures when it came to loans. Equity as well, we had to come around the table and try and re-look at our initial kind of investment thesis that we had around the business, and try and see if the business can pivot to save itself in the medium and short term. I think, you know, this time has actually given us a chance to be actually more aggressive with investments, because suddenly you did get some companies that realized it was an excellent opportunity to take advantage of some of the additional funding that came around, and managed to actually do more investments the last year than we did the year before that. You know, obviously managing the softer problems that came with companies having a lot of strain during COVID, as well as also managing those who are feeling far more hopeful due to them perceiving that the risk appetite has increased post-COVID.
All right, thank you very much for those insights. We're going to move on to our next poll question. And as we pull it up, I think one of the things that my key takeaway from both your contributions, Vuyiswa and Ketso, is that it's not just about the investment and the sexy sectors, but going forwards, we are going to also need to make jobs creation a priority. So if you think of impact and investing in an impactful company, it can't just be about a very large PE multiple, but also about how do you create jobs in the process. So the poll question is up, and it goes like saying, what needs to be the top priority in the VC industry to fuel economic growth? So the first thing is around policy changes. The second one is we need more VC fund managers. And the third option being more institutional capital into VC. And then we also have an other option. I'm going to give you a few questions, a few minutes to answer the question, and then the answers should pull up. All right, so 26% of you said that we need more policy changes, and then 2% said there's a need for more VC fund managers. And then the most popular response was that 62% of the participants is that more institutional capital to flow into VC, and then 10% was other. So this is quite a nice segue into my next question, and it's to you, Stephan. So the government made a decision to do away with Section 12J. Obviously, this shrinks the potential of VCing the country, even though a lot of inflows, many 12J entities will prove to have received a lot of inflows this year. But then it's important, it was deemed as a very important vehicle to foster VC, particularly for SMEs. But in your view, what's your view on this decision, and how do you think the VC sector will be impacted now that the 12Js will be done away with as of 30th June this year?
Yeah, I think, I mean, this is purely my own view, but I think it was a big mistake. I think in the context of where we need to go as a country, you know, we need to put all our money into transforming the economy. We're not going to transform the economy by just trying to squeeze more money out of the existing companies. So, and if you look at the VC asset class as a whole, you know, the amount of innovation at the fund manager level in terms of coming up with opportunities and you know, finding the gems out there, that can only happen at the private sector level, where people are on the ground and they are really trying to find those opportunities and working to not just put money into the opportunities, but really trying to get to those returns and some of the returns that were mentioned earlier already. So, I mean, for me, that was very short-sighted. You know, if you even look, I mean, in DTI's own papers, you know, some of the case studies that they looked at for 12J and looking at, you know, the Chilean market, in the beginning, the first time around when they put money into Chile, into early stage investments, I mean, people went and invested into tennis clubs and, you know, totally random kind of things. And they reviewed that and they said, okay, fine, this is not exactly what we would like to have, you know, but let's improve that, let's fine tune that. And that's what we needed to do. And I'm not saying the opportunity has left the bus. I think there are definitely more opportunities to learn from the lessons of 12J and integrate that into, you know, into new instruments. It's just the amount of time that went into it, and the lag time to, you know, to bring new things to the market at the policy level is substantial. You know, so we had something where we had traction. And you know, now we've gone and put it on ice. I mean, from a VC sector point of view, there's no doubt that the money that went into it, you know, I'm not in a position. I'm not Treasury, and I did not do the, you know, the review and looked at their arguments. But a lot of that money went into really good opportunities and created not just fund managers, but that brought new fund manager opportunities into this space. And it landed on the desks of real entrepreneurs, and we're seeing the results of that. And we're going to continue to see the results of that in a number of, you know, years going forward. So, you know, for me, I mean, what does it help in 5 years' time? We look back at 12J and we said, wow, actually, you know, despite the, you know, the things that were said in the media, we actually had huge successes out of this thing, you know. But now 5 years have gone down the line. So I think we missed a real valuable opportunity. I think from a positive point of view, it brought a lot more attention to the VC space. There are more people interested and aware of this space than before. The fund managers that were able to get off the ground, and I think with, you know, increasing influx from investors into the space, and we spoke about corporate earlier, but also funds of funds, it means that there are more players and more money. So I think the impact will be lasting and it will be good. It might slow down a little bit now because, you know, some of those people have to go back to, you know, basic fundraising, which is difficult, which is, you know, it does not come easy. Yeah, so we're shooting ourselves a little bit in the foot, but I think in the long run, we did actually create something that is going to have a lasting impact. And hopefully through other interventions, we can learn from that and take what was good out of 12J and bring it back to market as quickly as possible. Bottom line is we need money, and we need money from entrepreneurs, not just people that are blindly putting money into the space, but people that understand the space and that are putting pressure on the fund managers to really allocate their money towards things that will give them the return. So yeah, let's see and let's hope that we, you know, especially in the light of what's happening recently, you know, I mean, we really need to be open-minded and prioritize these kind of incentives and policies that stimulate new creation, new opportunity creation. Otherwise, we are not going to grow the economy.
I couldn't agree more with you, Stephan. Thank you so much for those valuable contributions. And Matsi, to you, just to build on what Stephan has said, you're currently working on developing the Startup Act in South Africa. So we know that there are certain aspects of the 12J, the Section 12J that has worked well. Do you think there's opportunities by which it could be remodeled and integrated into what the Startup Act aims to achieve?
Sure, Mosidi. I think it's important to identify why it was stopped, and it's not for a lack of trying, and it's not for a lack of impact. It did have impact, but the impact was too small, but that doesn't give it a reason to stop it. It's how do we refine it to ensure that now it's not, it's a bigger impact, it's more inclusive. So I'm in agreement of how do we refine it to make it more compelling, and also it's a timing thing. It's the time that we've had it, is it enough time to have seen the impact of it? And I also saw the results around policy. Should we be changing policy? Should we be having more institutional investors? It's a combination of all, because once we make it law that, let's say, institutional funders or institutional funds contribute X amount of money towards Section 12J type ventures or venture capitalists, or contribute their money into the SMME fund, if it's law, then there's a clear channel, instead of us now having to find and figure whether we have the right networks to be able to get money out of family businesses or family funds. But if something is legislated, it's part of policy, and there is a clear framework as to how it's going to work. There is a clear framework as to what is its benefit to the country. A lot of research has been done, let's say Endeavour, because they have high impact, high growth entrepreneurs that are in essence, South Africa by inception, but then they have an intention to grow globally. So if we have a policy framework that also includes how do we fund these ideas that are going to go global? How do we protect the intellectual property? How do we ensure that we are making South Africa more attractive in terms of direct foreign investments into our ventures? It needs a clear framework. And right now we don't have that. We have the National Small Business Act that really speaks to small business development in South Africa. But if you read it, it doesn't really speak to high growth, high impact startups, doesn't speak to the incentive structures around research and development, and how does it integrate institutions of higher learning. So the Startup Act, which is what we are working with, and I'm happy Stephan is on the call because he's been doing the research around the position paper for a Startup Act, is how do we create a clear policy framework? We're not necessarily asking the government to invent something that never existed, because there are elements of it that are already there. But now, even with the National Small Business Act, they're in the process of refining it. So part of the refinement can include a part that speaks to high impact, high growth startups. Let's define what that is. Let the government understand what value it adds to South Africa, understand the nature of challenges that it has, which lack of funding is part of it, intellectual property protection, intellectual property transfer, talent. So we have a myriad of challenges that we have, but it's how do we work with the government and the private sector and civil society organizations and create a clear framework that would also integrate funding for small business and creating incentives when you do actually fund, and then also getting big institutions to be able, fund managers to be able to contribute a percentage, even if it's 0.01%, let it be something, and let it be channeled to the likes of venture capital in South Africa.
Thanks for that. And just to build on to that, my question to you, Ketso, is there's a clear need, according to the audience, where 62% says there's a dire need for institutional funding needs to go towards bolstering VC, given the scope that pension funds have to invest up to 15% into alternative investments. In your view, how can we get the ball rolling to have that actively happening, where VC also gets, like Matsi said, a certain percentage of that allocation from pension funds into alternative investments?
Well, if you look at the US, which is one of the more mature VC markets, over 60% of the funding that goes into VC is institutional. So that's a good indication that hopefully when we are a more mature VC environment, we will begin to see, a similar thing. Most countries that have eventually managed to get institutional investment into VC, governments played a significant role, either by providing first loss capital or by limiting the upside on their money and giving it to the private sector investors as an incentive to come into VC. In South Africa, unfortunately, our government has not come to the party in incentivizing private investors to come into VC. But I think we have to do it, ourselves as an industry and as an ecosystem. And I think we will begin to see us turn that corner when just one or two pension funds, make the and say we understand this asset class, we're not scared of it. We do understand that it can provide, very good financial returns and an impact, and make the transition to putting some of their money into it. And most recently, we saw the Mine Workers Investment Company commit $10 million to the Series B knife fund. Congratulations to both the parties in achieving that outcome, because it's a huge step forward for our ecosystem that something like that can happen. We, as the SASME Fund, are trying to play the role a government should. We are raising a fund of funds in which we are charging no fee, taking no carry, and providing at least 15% of first loss capital ourselves as a way of trying to incentivize private institutional investors to come to the party. And I think we're getting there. I think we're close. And hopefully by this year or early next year, we'll have a pension fund invested into venture capital in South Africa. So, between what NIFE has done and MIC has done and what we hope to do, I think we are going to begin to turn the corner. But the nicest thing would be if government came to the party and did what many other governments have done in providing the incentive for private investors to come into VC.
Excellent contributions. Thank you so much for that, Ketso. So before we move on to the questions and answers, just as a parting shot, it's a question open to each of you. There's a lot of evidence around how COVID-19 has created various gaps in the market as well that require a more inclusive lens from investors to go into unfamiliar territory when it comes to seeking opportunities. I look at one example that comes to mind is Yetu. It's a small startup, early stage startup, looking to leverage the taxi networks to provide online delivery services in the township economy. And then this opportunity came as a result of lockdown level 5s, where people couldn't shop anyway in the townships. So, and then there's also a lot of entrepreneurs solving problems for the majority of South Africa's population, and they need funding. And the current unrest that's happening in Durban and in Joburg is one of the key things that I take away from it, is that people in the townships and the rural areas are desperately seeking to be active participants within the economies where they consume. They also want to be some form of shareholders, because if you are a shareholder in something, you won't burn it up. So in your view, what can be done within the ecosystem to bolster more VC into powering entrepreneurs, particularly in the township and the rural economies?
I can say a few words before I pass it on to the other panelists. I think it's up to us as VC fund managers to push the boundaries with our funders as well. Actually bring across examples of businesses that are outside the norm, and put them up for funding, and challenge our funders to actually look at those businesses. Because often we ourselves shy away from those businesses in the thinking that our funders won't like it. So it's up to us to also push the boundaries. But also, I've always viewed township economy is SA economy. Often it's treated as separate, and it shouldn't. Just given where our population lives, rural and township mostly. For me, it's one and the same thing. And so really getting across the importance of funding those areas more than your commercial city centers is equally important.
Thanks. Thanks for the.
Yeah, no, Vuyiswa, I agree with you. Yes, the township economy is a South African economy, and also it's how do we provide the infrastructure to nurture and enable township entrepreneurs to be able to, grow businesses, organically grow businesses. The reality is, Sandton doesn't need any more working spaces and technology hubs. But every time you hear of there's a new office space that's being built or that's coming up, it's not in a township environment. So how are they supposed to know what the value of technology is? How are they supposed to know how they can participate within that value of technology? So how do we create infrastructures that would enable high impact, high growth technology to come? Because then on that, it's then everything else should organically happen. Because also if you look at universities, those are great environments where technology comes. So technology transfer offices that exist within university environments. So how do we make more of those, that kind of skill set, that kind of infrastructure to be in environments like a township environment? Because we have to literally take 1 or 2 taxis before we get to opportunities. There's an additional layer that makes it harder for township entrepreneurs to be able to access the opportunities that exist and understand also what value they can create and contribute toward that. So one model that I've loved, it's the Innovation Hub. It has Ikasi Labs. So these are like township hubs, within township environments. And I remember when Stephan and I were collecting data around for the position paper of the Startup Act, the one particular group that we enjoyed engaging because we got so much value out of was from the Ikasi Labs guys. I mean, they really added a lot of value. So there is something that exists, but how do we facilitate it? But how do we bring resources and infrastructure and focus on it, and proper focus, not just we will give you a slither of that. We will give you proper infrastructure that exists within peri-urban and urban areas that we have.
Great, thank you for that. Any additions from you, Ketso or Stephan, on that question?
Yeah, I mean, I think there's a couple of headings that might be useful to just think about, finding solutions and finding new things that entrepreneurs could do. I think we are seeing a significant failure from government in service delivery. So almost any entrepreneur that can find an affordable quality service, whether it's in health or whether it's in education or any other service, I think is going to do really, really well. Finding new ways that are more effective for delivering things that are currently being delivered. We've seen an organization called A2Pay work with existing spaza shops, putting in a device which not only sophisticates the operation, but also gives them new revenue streams in that they can sell prepaid electricity and prepaid airtime and all sorts of other things. And once you layer a little bit of working capital on the top of that, we've seen unbelievable results. So that's just doing the same thing, but in a much more effective way. We've also seen people respond to basic needs, whether it's housing or property development. There's an organization called Umastandi that is working with township property developers in a very formal way, organizing mortgages for them to do incredible housing and other property developments within the township. And I think that the last point is to try and redirect some of the scientific and IP innovation to find solutions to problems that are South Africa and Africa specific. And I think we've got a huge advantage because we live here and we understand those problems better than most people do. So I would say, if we think about those headings and try and find ways in which we could shepherd money and entrepreneurs and debate and ideas into those things, I think there's huge upside for the country.
All right, thank you so much. Stephan, anything from your side?
Yeah, I think, I mean, if you, the one thing that stands out for me, and this relates a little bit to Section 12J as well, but just in general, I mean, everybody is familiar with the Silicon Valley model, or, if you look at Cambridge in the UK, or you look in Switzerland, and it's very clear to see what those clusters and those strengths are. So if you talk about, the whole, from a software point of view, or you go and look at high tech and you think about Silicon Valley, then it's, you expect that some of the great entrepreneurs are going to come out of those ecosystems, or they're going to, to be attracted to those ecosystems. So then you ask yourself, so what are we good at in South Africa? And we are all very familiar with the fact, because we keep saying it, we are all very familiar with the fact that our financial services are renowned for what it's done over the years, and some of the innovations that's been first to market, first not just in South Africa, but in the world. So when we talk about these entrepreneurs, somehow we need to bring these things together and to say, we need to recognize the entrepreneurs that are sitting in our financial services. And really mobilize those people. If you look at some of the examples that came out of investment cases, where all it took was to recognize the insights from a financial services point of view and bringing money to those entrepreneurs. Somehow when we think financial services, we think these are people that are just got, they got to write the checks, or they got to do the bond approvals, or whatever the case may be. But the people in South Africa that are sitting at the cold face for seeing where these market opportunities are, and to really empower the people on the ground, are often sitting in the financial services sector. So if we're saying this is our largest sector in South Africa, we need to resource that. And then coming back to 12J and talking about venture capital, the entrepreneurs are not just the guys that are sitting out there. It's the people that are often being looked at from a VC point of view, the fund manager's point of view, and they've got the opportunities and the entrepreneurial spirit to go after those. So for me, that is critical. We've got to bring these things together. We put an enormous amount of money into other sectors, where we're hoping that entrepreneurs are just going to arrive out of the sky. It's just going to suddenly appear out of nowhere. But entrepreneurs are bred by those ecosystems. So if our ecosystem is very strong in the financial services, we've got to resource them. Thanks.
Thank you so much. I'm going to take this time to move over to the questions and answers so that we can take as many of them as possible. The first question is from Thomas van Hylen. He's curious to see if you have any information from a VC perspective, the percentage of capital deployed into new companies versus existing portfolios in the past year. That's the one question I have. And then I'm just going to quickly move over to the chat to see if there are some more. I see that Cora, hi Cora, who was in the call, has been also asking a couple of them. Tanya, do you mind maybe just driving the question? Sorry, I'm using my iPad, so it's very difficult to kind of like field them. But there's a question here for Stephan just to start. So the one more question for Ketso is that should we have a differentiated fund terms to accommodate similar VC funds and facilitate sustainability? That's the question to you, Ketso.
While Stephan is finding his data so that he can answer new deals versus portfolio deals, we have definitely seen the need for differentiated terms and trying to deal with the kind of challenges that you find typically in the early stage VC industry. So teams are small and funds are relatively small, which means you can't apply the 2 and 20 model that you typically apply from private equity in VC. And what we've done to try and accommodate and facilitate the process, we've done a couple of things. One, we've provided almost all our funds with seed capital so that they can build their own pipeline over time. 2, we've given them more than a 2% fee. Our highest fee, I think, is about 3.75%. Thirdly, we've tried to incentivize the manager by having a 0 hurdle so that you share in the carry from the time that you return the capital. And I think there are probably other innovations that are still available to us. The one that we have used for the women-managed VC fund is the management fee is not enough to pay for 2 people. So we've hired one person as an intern over a 4-year period, and we pay their salary outside of the fund structure. So I think investors are going to have to be pretty flexible in trying to make the VC industry more sustainable, because the typical 2 and 20, 10% hurdle thing is not going to make it, very easy to grow this industry. I think once we mature, we might be able to get there, but I think we are a few years away from doing it.
Okay, great. Thank you. We're going to move over to Thomas's question.
Okay, I can answer that. Yeah, so in terms of the allocation, just short of 2/3 of the new deals that were made in 2020 went to new opportunities. So 66% went to new opportunities. If you look from a money point of view in terms of where the money was spent, that accounts for more or less 55% of every rand spent in 2020 was on new opportunities. And I think that might change a little bit next year, because keep in mind that these pipelines don't just arrive overnight. So a lot of that pipeline would have already been developed in 2019. So people executing on those at the beginning of COVID. But yeah, I think the appetite is very much still towards towards new opportunities.
Okay, great. Tanya, I'm going to hand over to you to see if there's any other questions that I may have missed in the chat.
Mosidi, there aren't any other questions, but there were some good comments that came in, and some of the comments relate to the fact that we need to understand what are the challenges and constraints for institutional investors in South Africa to be able to allocate to VCs, and then also the fact that we've got this reality that we've got investors and stakeholders that see South Africa as a very high risk environment. So not only locally, but international investors in particular see the region as a high risk, not only venture capital as an asset class, but the region. So those are some of the comments that came in terms of things that we need to take into consideration. I don't know if the panel has any comments based on those ones that came through.
I'd like to just respond to that last point, Tanya. I think the reality is that VC is seen as high risk. South Africa is definitely seen as high risk. It's not a well-known asset class. So as an industry and as an ecosystem, we've got to figure out what are all the kinds of things we can do to make it easier for investors to come to the party. And, mobilizing a blended finance structure with first loss and limited upside going to certain investor categories is one way of doing it. Building more grindstone accelerator type programs so that people can get a much bigger sort of sense of what the possibilities for the pipeline and for investing are. Highlighting the exit stories as soon as we have a few more. I'm sure we'll do a better job of it. And encouraging other VCs to join Knife in raising a Series B fund so that we can show scalable businesses that grow, and can attract $10 or $20 million ticket sizes. I think all of those things over a period of sort of 2 to 3 years will begin to change perceptions and lower actual risk. I don't think it's high risk, it's perceived high risk, and we need to make all of these changes so that we can begin to attract the kind of institutional investors we need. Because without institutional investors, this industry and this asset class is just going to remain relatively small, and we as a country, we can't afford that. Thank you.
Yeah. Thanks for that. And then just a comment here from EK, and they say a harsh reality is waiting for us investors and stakeholders post this unfolding crisis. It's time to act, invest in VC and create jobs. What is the panel's view on actionable new strategies to do this, given this new reality unfolding?
I also feel that we speak a lot amongst ourselves, because if we talking about we need more institutional investors, where are they? Like, where are they in any of the conversations that we're having about them, if they are the missing link? So how do we bring them to the table? How do we showcase what the potential is and also what the impact currently is? And I think, from, let's say, SAVCA perspective, a SiMODiSA perspective, let's have more conversations with them. Let them be part of the panelists, and then they will be able to tell us if this is something that's possible, if here are the challenges. Perhaps inclusivity might be a challenge for them, because this sector tends to attract more, white people versus Black people en masse. So how do we get the relevant audience to be here that actually has the ability to make those decisions? I think that's one strategy or an actionable thing of saying, how do we bring them more into these conversations so that collectively we talk about the challenges and also potentially the solutions?
Thanks for that, Matsi.
Yeah, I can also add from my side. I mean, from a yeah, I'm the one with the data, but the reality is we need to bring these business cases to government. I think what's unfolding in the country is just, again, emphasizing the fact that, you know, we need to change things. And we are sitting at the forefront of change. We've got the data, we've got the case studies, we've got the examples, you know, this new economy that we're working towards and that we're seeing a micro part of within this asset class. We need to elevate the awareness of that. And really get those stakeholders that Matsi is talking about around the table. I mean, I think personally, you know, my perception is from a national government point of view, there's going to be more of a willing ear for what we are promoting. We're in a better space to bring these things because we've actually got answers. And it's not 10 years ago where, you know, it's pie in the sky and we're hoping that these things are going to work. We've got the examples, we've got the case studies, we've got the facts. But we need to beat that drum and bring that message to the forefront very, very aggressively.
Thank you, Stephan. I'm going to hand over to Tanya now for the purposes of time. Thank you, everybody, for joining us. She's just got a few important announcements to make, so please stay with us for a few more minutes.
Thank you so much to panel and Mosidi for driving the conversation. It was really compelling, really interesting, great insights. As I said in the beginning, there is a competition. And if you can all open your chat function, it's fastest finger first. The question is, what date did you see bounce up and down when we showed the slideshow? Sure. Jenna was the first one to respond. Jenna, congratulations, you've won the prize. And if we can maybe put the slide up. And Matsi, this actually answers your question. Where do we get the institutional investors in the room to have the conversation? Well, the 15th of November at the SAVCA 2021 VC conference taking place in person, or you can join virtually. Thank you to our lead sponsor, the SA SME Fund. And the fastest finger first, Jenna, you win a ticket to the conference. Congratulations, we will be in touch. And something interesting, our MCs at the conference is this dynamic duo, Mosidi Modise and Matsi Modise. They'll also be joining us the conference as the MCs. So this was a little taster of what's to come. We hope you can join us. We will share the registration link. And we want to wish everyone a happy or a good evening. Please stay safe, look after yourselves and your families. And let's continue to grow this country and this economy together. Have a great evening, everyone.